But for more on the Magnificent Seven and sort of broader picture related to Nvidia and tech, the latest on earnings season, what this all means for stocks, let's welcome in Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Hey, Gabriela, thanks for being here. So you heard what we were saying about Nvidia and just this sort of, as I said, fixation, obsession, the hype, the excitement over AI. How important is this one report for the market?
It is very important because we're speaking of the fifth largest company, which has contributed year to date about a third on its own of the S&P 500 return. And you mentioned that implied volatility from the options of a plus or minus 10% move on its own that could contribute plus or minus 40 basis points at the index level. So it certainly matters quite a lot, and perhaps even more maybe than CPI last week or retail sales last week. But I think moving on a bit more broadly from just Nvidia, the Magnificent Seven, what I think is the big theme for this year, once we actually start getting first quarter earnings and beyond, is the delta that's happening in other sectors that had an earnings recession last year, ex-Mag 7, that are now having a high single digits earnings recovery this year. So it's that combination of a positive change on the revenues, not even that crazy expectation for revenues or margins, plus, of course, more subdued expectations, positioning, and valuations.
And Gabriela, what are your expectations for corporate profit growth this year?
So at the moment, consensus is looking for 11%. If you break that down, two things have to happen. First, the Mag 7 have to continue delivering 25% plus earnings growth on top of a high base last year. And there we're already seeing that not all of them actually meet that bar or even have very good earnings, never mind excellent. But you also need to be able to see something actually a bit more doable, which is exactly those other 490 stocks go from minus 8% to plus 6%. And that actually to us sounds pretty reasonable. If you have a scenario as we do of positive economic growth, positive revenue growth, plus margin stabilizing. To me, that was the big takeaway from the fourth quarter. It seems we're past the margin pain. It's back to pre-COVID levels or pre-COVID trend. And so we think pretty doable to have very high single-digit earnings growth this year.
And so what does that imply for stock returns, right? We've had, many of different strategists at different banks have recently been raising their forecast. Goldman Sachs raised their forecast. I think UBS is now at a street high. Is that a reasonable expectation that earnings growth is going to translate into positive returns?
So we do think so, and ultimately last year was a lot about multiple expansion and a little bit less about upward revisions to earnings expectations. I think this year, it's a bit of the opposite. It's much more about earnings expectations, but you can still have pretty elevated multiples. You can always have higher PEs as long as the optimism is there, as we expect. And we do expect overall a positive year for the market. But I think when you're in a situation where you have had already such a heavy lift from the largest companies, the Mag 7, really, if you want to do a bit better than mid-single digits, where we're already at right now, is when we're starting to talk about playing the AI theme with other beneficiaries in the tech sector or across sectors, where we're talking about opportunities in slightly more unloved sectors like healthcare, industrials, and utilities. So really, we're big believers in this idea of broadening out, and we've started to see that, by the way. So the Mag 7 only contributing about half of returns.
Only.
Better than over 80% last year.
And Gabriela, we also got minutes from the Fed's last meeting, and that kind of suggested our central bankers not in any big rush to cut rates. What are sort of your expectations?
So I think I pulled up the minutes right before I came here because, and I always go to the participant section because for us, there wasn't going to be too much new information in terms of short-term rates, especially because over the past 2 weeks, we've had a significant repricing. We went from expecting 6 rate cuts this year to now between 3 and 4 rate cuts, and they've gotten pushed back to June from March. So I think what we saw in the minutes at this point became a bit stale. The market had already incorporated that. We're not seeing much of a reaction at all on the bond market. But I pulled it up to look much more the discussion on the balance sheet. An accelerated timeline than we expected has been suggested for winding down quantitative tightening. So far, nothing much from the minutes, but that's going to be the big action point at the March meeting. And that's actually something that puts a lid on long end yields as you're getting more supply absorbed by the central bank.
There have been a couple of voices, not many by any means, who have suggested we could even see another increase in rates because of the recent reads on inflation. Is that crazy to imagine that could happen?
We think it would take a substantial reacceleration in inflation. And reading the minutes, actually, yes, they're still vigilant around inflation risks. But if you look at the minutes, they showed a lot of comfort that the labor market was coming to better balance, so less concern about a wage price spiral. There was also much more comfort around rent coming down due to high frequency indicators suggesting that. And as Chair Powell said, really the inflation data doesn't need to get better. It just needs to kind of maintain its trajectory. And they're really focused on the trend, 3 months, 6 months. So of course the next few CPI reports will be important, and that's why we think they'll wait to June, right, to be able to garner more of a trend. And by June, we actually think we'll be in a 2 handle with core CPI and hence open the door to cuts.
All right, we'll see. Gabriela, thanks so much for joining us today, helping us kick off the show. Appreciate it.
Thank you so much for having me.
Thank you.